January 31st, 2020, 9:47 a.m. Eastern Time. On trading screens across Wall Street, Luckin Coffee's stock price began to collapse. In 90 seconds, it dropped 26%. By market close, $4 billion had vanished. $4 billion, gone, in a single trading day. This was supposed to be China's Starbucks killer, the tech-driven underdog that would revolutionize coffee in the world's largest market. A company that opened more stores in 18 months than Starbucks built in 19 years. A darling of Wall Street, a symbol of Chinese innovation, a unicorn that promised to change everything. Instead, it became the fastest fraud in modern Wall Street history. $300 million in fake sales, every single quarter. For over a year, Luckin Coffee had been fabricating transactions, inflating numbers, and lying to investors. The people who believed the story, they lost everything. Retirement accounts, college funds, life savings, all gone. But here's what nobody saw coming. The fraud wasn't discovered by regulators. It wasn't caught by auditors. Wall Street analysts missed it completely. The fraud was exposed by an anonymous email, 89 pages, no return address, no demands, just evidence, pure damning evidence. And it would bring down a $12 billion company in 72 days. How did Luckin fool the smartest investors in the world? How did they fabricate hundreds of millions in sales without anyone noticing? And who was inside, documenting everything, waiting for the right moment to strike? To understand how they pulled this off, we need to go back to where it started, back to October 2017 in a cramped office in Beijing, where a woman named Jenny Qian was about to make a very dangerous bet. Jenny Qian had a problem. She was the former chief operating officer of China Car Rental, one of the country's largest vehicle rental companies. She had connections, ambition, and a track record of building businesses. She was in her 40s, respected in Chinese business circles, and she wanted something bigger. She wanted to build China's first truly global brand. But there was one company standing in her way, Starbucks. By 2017, Starbucks had spent 19 years building its presence in China. They had 3,600 stores. They owned the premium coffee market. Chinese consumers associated good coffee with the green mermaid logo. Breaking that stranglehold seemed impossible. Then Jenny Qian had an idea. What if she didn't compete with Starbucks on coffee? What if she competed on something else entirely? She partnered with Charles Zhengyao Lu, a billionaire entrepreneur who had built CAR Incorporated and taken it public on the New York Stock Exchange. Lu had money, credibility, and a reputation as a visionary. Together, they launched Luckin Coffee in October 2017. The pitch was simple. We're not a coffee company. We're a technology company that happens to sell coffee. Everything about Luckin was designed to be different. No seating areas, stores were tiny, optimized for takeout and delivery. Every transaction happened through an app. Aggressive discounts pulled customers away from competitors. And the expansion strategy? Blitzscaling on steroids. In 2017, Luckin opened 9 stores. By the end of 2018, they had over 2,000 locations. Starbucks took 19 years to reach 3,600 stores in China. Luckin was on track to surpass them in less than 2. Investors loved the story, China's growing middle class, technology disruption, the David versus Goliath narrative. And the numbers looked incredible. Massive growth, rapidly expanding customer base, app downloads in the millions. On May 17, 2019, Luckin Coffee went public on the NASDAQ. The IPO raised $561 million. The company was valued at $4.2 billion. On the first day of trading, the stock jumped nearly 20%. Jenny Qian and Charles Lu had done it. They had built a unicorn. Wall Street analysts issued glowing reports. Some projected Luckin would overtake Starbucks in China within 3 years. One analyst called it the most exciting retail story in Asia. By the third quarter of 2019, Luckin announced it had surpassed Starbucks in store count, 4,507 locations compared to Starbucks' 4,300. The victory lap was complete. China's Starbucks killer had arrived. But there were red flags. Luckin was burning through cash, losing over $100 million per quarter. The unit economics didn't make sense. They were essentially paying customers to buy coffee. Every transaction lost money. Investors ignored it. Amazon lost money for years before becoming profitable. They reasoned, this is how you build market share. You spend now, profit later. Growth at all costs. What those investors didn't know, what nobody knew, was that the growth was fake. While Wall Street celebrated, COO Jian Liu was already fabricating sales numbers. The fraud had started in the second quarter of 2019, the exact quarter they went public, the quarter they told investors the business was accelerating. It was all a lie, and the lie had just begun. Here's how you fake $300 million in sales. You need 3 things: fake transactions, fake customers, and fake costs. Because you can't just claim revenue appeared out of nowhere. The numbers have to balance. The story has to make sense. Every fake sale needs a fake receipt, a fake cost of goods, a fake everything. Luckin's fraud was almost beautiful in its simplicity. Step 1. Create fake transactions. Across hundreds of Luckin stores, managers and employees would log into the company app using fake accounts. They'd place orders, large lattes, cappuccinos, cold brew, whatever, and pay using company credit cards. The system recorded it as a real customer transaction, revenue logged, sales counted. Then they'd brew the coffee and throw it away. Every day, across hundreds of locations, employees were making coffee for nobody. The stores looked empty because they were empty. But the app showed bustling sales, digital transactions, clean data, perfect numbers for Wall Street. Let's walk through a single fake transaction. August 6th, 2019, 11:23 a.m. A customer orders a large latte at a Luckin store in Hangzhou. Price 27 yuan, about $4. The order goes through the app, payment processes, the barista makes the drink. It sits on the counter for 5 minutes, then gets poured down the drain. The Luckin system just recorded a sale, $4 in revenue, one more data point showing growth. Now multiply that by 10,000 times per day, across hundreds of stores, for months. The second quarter of 2019, the IPO quarter, Luckin fabricated roughly $100 million in sales. Third quarter, $155 million. By the fourth quarter, they were faking $190 million in a single 3-month period. Over the entire year of 2019, Luckin fabricated more than $310 million in revenue. That represented roughly 22% of their total reported sales. Nearly a quarter of their business was fiction. But here's the problem with fake revenue. It creates a mismatch. If you claim you sold $300 million worth of coffee, you need to show you bought coffee beans, milk, cups, lids, everything. You need costs to match your revenue. Otherwise, the profit margins look impossible and auditors start asking questions. So they faked the cost too. Luckin created fake supplier invoices, fake purchase orders, fake contracts with coffee bean suppliers, packaging companies, logistics firms. They inflated the numbers to match the fake sales. The accounting ledgers balanced perfectly. Fake revenue matched by fake expenses. At least 12 employees were involved in orchestrating this. Led by COO Jian Liu, a network of reporting staff altered accounting entries, changed store sales reports, and manufactured documents. They knew exactly what they were doing. This wasn't a mistake. This wasn't aggressive accounting. This was systematic, deliberate fraud. And for over a year, nobody caught it. Not the auditors at Ernst & Young, one of the big 4 accounting firms, not the board of directors, not Wall Street analysts who covered the stock, not the investors who poured billions into the company. Luckin Coffee had become a theater production, actors pretending to run a coffee company. The stores were real, the app worked, the coffee existed. But the customers? Many of them were ghosts, digital phantoms in a spreadsheet. The fraud was self-sustaining. Fake sales in the second quarter became the baseline for third quarter projections. Fake third quarter numbers meant even higher expectations for the fourth quarter. Each lie required a bigger lie to cover it up. By October 2019, they were trapped. Telling the truth would mean admitting everything. The stock would collapse, lawsuits would follow. Criminal charges, the end of everything they'd built. So they kept lying, kept faking transactions, kept brewing coffee and pouring it down the drain. But someone inside the company was watching. Someone was keeping records. And that someone was about to burn it all down. December 15th, 2019, 11:47 p.m. Beijing time. Board members at Luckin Coffee received an email. The subject line was simple: Luckin financial misconduct. Attached was an 89-page document. No signature, no return address, just evidence. The report was devastating. Whoever wrote it had done their homework. They had compiled months of research, store-by-store traffic analysis, receipt collections from 620 stores across 45 cities, employee testimonies, some recorded secretly. The conclusion was damning. 69% of Luckin's reported store sales were impossible. The foot traffic didn't match the claimed transactions. The numbers were fabricated. The board faced an impossible choice. If they ignored the report and it leaked, they'd be complicit in fraud. If they investigated and found evidence, they'd have to report it, destroying the stock price, triggering lawsuits, ending careers. For 6 weeks, they tried to verify it quietly. They hired investigators, reviewed internal records, interviewed employees, and what they found confirmed their worst fears. It was all true. But before they could decide how to handle it, the secret got out. January 31st, 2020, 9:30 a.m. Eastern Time, market's about to open. Then a tweet appeared from Muddy Waters, one of the most famous short-selling firms on Wall Street. The tweet read, "We've received an extraordinarily detailed report on Luckin Coffee claiming fabricated sales and inflated numbers. We're convinced." Wall Street erupted. Trading in Luckin stock was immediately halted. When it resumed, the collapse began, down 26% in 90 seconds. By market close, the stock had lost nearly half its value. $4 billion in market capitalization, gone in 6 hours. Investors panicked. Analysts scrambled. News outlets ran breaking headlines. Luckin Coffee faces fraud allegations. Chinese Starbucks rival accused of fabricating sales. Short seller claims Luckin numbers are fake. The board had no choice now. They had to investigate publicly. In February 2020, they hired Kirkland & Ellis, one of the world's top law firms, along with forensic accounting teams. The investigators descended on Luckin's Beijing headquarters, seized servers, interviewed employees, and analyzed transaction data. What they found was worse than the anonymous report claimed. The fraud wasn't just the fourth quarter of 2019. It went all the way back to the second quarter, the IPO quarter, the quarter they raised $561 million from investors. The quarter they told everyone the business was accelerating. They'd been lying from the beginning. On April 2nd, 2020, Luckin Coffee issued a public statement. The language was carefully crafted by lawyers, but the message was clear. The company has identified fabricated transactions from the second quarter through the fourth quarter of 2019 amounting to around 2.2 billion yuan, approximately 310 million US dollars. 22% of their annual revenue, fake. The stock collapsed again, from around $26 per share to under $5 in a single day. Then it kept falling. $4, $3, $2. Investors who bought at the IPO price of $17 had lost over 90% of their money. The company that was supposed to be China's answer to Starbucks had become the fastest fraud in modern Wall Street history. And the person who exposed it? Still anonymous? Still unknown? Somewhere out there, someone who worked at Luckin had spent months compiling evidence, risking everything and finally pulling the trigger. They never came forward, never revealed their identity, never explained why. But the damage was done, the fraud was exposed, and now came the reckoning. Meet David Zhang, 34 years old, software engineer, lives in Seattle. Chinese immigrant who came to the US for college and stayed for the American dream. In June 2019, 1 month after Luckin's IPO, David invested $80,000 of his savings into Luckin stock. It wasn't his entire portfolio, but it was significant. Money he'd saved over 5 years. Money he planned to use as a down payment on a house. Money he'd set aside for his kids' college fund. He believed in the story, a Chinese company taking on Starbucks, technology disrupting an old industry. His parents still lived in Beijing. They'd told him about Luckin stores opening everywhere, how convenient the app was, how the coffee was actually good. David bought at $22 per share. By January 2020, it had climbed to $50. His $80,000 had become $180,000. He was ecstatic. He told his wife they could finally buy that house in Bellevue. Then came January 31st, 2020. David was at work when the Muddy Waters tweet went out. He checked his phone during lunch. Luckin stock, halted, news alerts, fraud allegations. He refreshed obsessively. When trading resumed, he watched in real time as his portfolio collapsed. $50 became $38, then $26, then $18. By market close, his $180,000 had become $70,000. He'd lost more than his original investment in 6 hours. He didn't sell. He thought it was an overreaction. Short sellers attacking a good company. He'd read about this. Market manipulation, hit pieces, temporary panic. The company would release a statement, clear things up, and the stock would recover. It didn't recover. April 2nd, the confession. The stock dropped to $4. David's $80,000 became $14,000, then $10,000, then $6,000. By May, Luckin stock was trading at $2. David's investment was worth $7,000. $80,000 had become $7,000 in 90 days. He never sold. He couldn't. Selling would make the loss real. So he held on, hoping for a miracle that never came. Years later, in an interview with a financial news site, he said, "I kept thinking, how did nobody catch this? Ernst & Young audited them. Wall Street analysts rated them a buy. How did everyone miss it?" David Zhang wasn't alone. Institutional investors, pension funds, hedge funds, mutual funds collectively lost over $2 billion. BlackRock, the world's largest asset manager, lost millions. Fidelity, Tiger Global, Charles Schwab, all burned. But the damage went beyond investor losses. Within 3 months of the fraud's exposure, Luckin laid off over 4,000 employees. Store managers who had nothing to do with the fraud lost their jobs, their reputations tainted by association. Some had worked 18-hour days, believing they were building something real. They'd opened stores, trained staff, managed operations, and suddenly it was over. One former store manager in Shanghai told reporters, "I didn't even know what fabricated transactions meant. I just sold coffee. And then one day, I got an email saying my position was eliminated." The executives didn't escape. COO Jian Liu, the orchestrator of the fraud, was fired. He faced investigations in both China and the United States. CEO Jenny Qian was forced out in July 2020. She later faced charges from the SEC and was eventually banned from serving as an officer of any U.S. public company. Chairman Charles Liu resigned. He paid a $180 million settlement and was barred from serving as a director or officer of a U.S.-listed company for 10 years. Ernst & Young, the accounting firm that audited Luckin and somehow missed $310 million in fake sales, faced lawsuits and regulatory scrutiny. Their reputation took a massive hit. Questions swirled. How did they sign off on financials that were 22% fabricated? What exactly were they auditing? The SEC moved fast, for once. They launched an investigation immediately after the fraud was revealed. By December 2020, Luckin agreed to pay a $180 million penalty to settle charges. It was one of the largest penalties ever imposed on a Chinese company. But $180 million? For a fraud that destroyed $12 billion in market value, for investors who lost life savings, the math didn't add up. Class action lawsuits were filed. Investors sought over $1 billion in damages. Some of those cases are still working through the courts today. On June 29, 2020, NASDAQ delisted Luckin Coffee. The stock that once traded at $50 was removed from the exchange. Investors were left holding shares in a company that no longer existed on any major U.S. exchange. David Zhang never got his money back. He lost $73,000. His house in Bellevue, still a dream. His kids' college fund? He's rebuilding it slowly, through index funds and savings. He'll never touch an individual stock again. In an interview, he said something that stuck with me. I learned that when everyone's excited about a stock, when the story sounds too good to be true, that's when you should be scared. That's when you should walk away. But he didn't walk away, and thousands of others didn't either, and that's exactly what Luckin was counting on. So why did they do it? It started small. It always does. Second quarter 2019, right after the IPO, Luckin had just raised $561 million. They'd told investors growth was accelerating. Wall Street expected strong numbers. But they missed projections, not by much, maybe 8%, close but not quite there. COO Jan Liu faced a choice: report the real numbers and watch the stock drop, or inflate the numbers just enough to meet expectations. Make up the shortfall next quarter when growth picked up. He chose to lie. The logic was probably seductive. We're so close. The business is growing, just not fast enough to satisfy Wall Street's impossible expectations. We'll hit our targets next quarter, and then these fake numbers won't matter. We're borrowing growth from the future. But next quarter came, and they faced the same problem, except now it was worse. The fake second quarter numbers had become the baseline for third quarter expectations. They couldn't just meet the real third quarter growth, they had to exceed the fake second quarter growth. So they faked more, $155 million in the third quarter, then $190 million in the fourth quarter. The fraud became self-sustaining. Each quarter's fake numbers made the next quarter's targets impossible without more fraud. They were trapped in a spiral of their own making. By October 2019, they were fabricating nearly $200 million per quarter. Stopping would mean admitting everything. The stock would collapse. Lawsuits would follow, criminal charges, careers destroyed, reputations ruined. So they kept going, kept brewing coffee for nobody, kept logging fake transactions, kept lying to investors, analysts, regulators, and themselves. In leaked internal messages that surfaced during investigations, executives rationalized the fraud. All growth companies adjust numbers. We're not really lying, we're projecting forward growth. The business fundamentals are strong, the numbers just don't reflect it yet. But they knew. Of course they knew. You don't fabricate $310 million by accident. You don't create fake supplier invoices and alter accounting records because of a misunderstanding. This was deliberate, calculated, criminal. The pressure came from everywhere. Quarterly earnings calls where they had to report growth or watch the stock crater. Competitors like Starbucks who were thriving, they needed to show they could compete. Investor expectations. You promised unicorn growth. You promised to disrupt coffee. Deliver or collapse. And underneath it all was the original sin of modern startups. Growth at all costs. Profitability doesn't matter. Unit economics don't matter. Just grow, blitzscale, capture market share, worry about making money later. That philosophy enabled the fraud. It created an environment where lying felt like the only option. Because telling the truth, admitting that sustainable growth takes time, that profitability matters, that maybe you can't beat Starbucks in 18 months, that truth was unacceptable. But someone inside couldn't live with it. Someone on Luckin's accounting team or operations staff saw the spreadsheets and couldn't stay silent. That 89-page report didn't write itself. It took months to compile. Store visits, receipt collection, employee interviews, data analysis. Whoever wrote it knew exactly where the bodies were buried. They had access to internal systems. They understood the fraud mechanics. They documented everything meticulously, and then they waited for the right moment to strike. December 15th, 2019, right before year-end financial reporting, right when the board would be reviewing numbers, maximum impact. That anonymous whistleblower destroyed a $12 billion company with a single email, and they never revealed their identity, never came forward, never explained their motives. Were they a hero, a disgruntled employee, someone with a conscience who couldn't watch investors get scammed? We'll probably never know. But their timing was perfect, and their documentation was flawless. They knew that without ironclad evidence, the board might ignore the allegations. So they brought receipts, literally. The fraud collapsed because one person refused to be complicit. One person said no. One person decided that truth mattered more than protecting the company, their job, their colleagues. In the end, that's always how these stories end. Not with regulators or auditors or analysts catching the fraud, but with someone inside who decides they can't live with the lie anymore. Luckin Coffee wasn't just a corporate scandal, it became a geopolitical flashpoint. By 2019, Chinese companies were flooding U.S. stock exchanges. Alibaba, JD.com, Pinduoduo. Investors were desperate for exposure to China's booming economy. Everyone wanted to find the next Alibaba. The growth stories coming out of China were intoxicating. Luckin fit perfectly into that narrative. Chinese company using technology to disrupt an American giant. The David and Goliath story that investors love. The East meets West innovation tale. And then it all fell apart. $310 million in fake sales. A fraud that lasted over a year. Auditors who missed it. Regulators who didn't catch it. The fallout extended far beyond Luckin. Trust in Chinese companies evaporated. Questions emerged. How many other Chinese firms were faking numbers? How reliable were audits of companies based in China? Could U.S. regulators even access the information they needed? Congress moved quickly. In 2020 and 2021, new laws were passed allowing the SEC to delist Chinese companies if their auditors refused to comply with U.S. oversight. The PCAOB, the Public Company Accounting Oversight Board, had been trying to inspect Chinese audit work for years, but Chinese regulators blocked access. Luckin exposed how dangerous that regulatory gap was. Dozens of Chinese companies faced heightened scrutiny. Some were delisted, others chose to delist voluntarily rather than face new audit requirements. The golden era of Chinese companies listing in the U.S. began to crumble. But there was another angle to this story, one that's uncomfortable to acknowledge. The short sellers were right. Muddy Waters, the firm that tweeted about Luckin and triggered the stock collapse, made an estimated $100 million shorting the stock. Their founder, Carson Block, became a hero to some, a villain to others. Here's the thing. Short sellers have a profit motive. They make money when stocks fall. They're incentivized to find problems, publicize them, and profit from the panic. That doesn't make them altruistic. But in Luckin's case, they were right. When regulators failed, when auditors missed it, when analysts kept issuing buy ratings, the short sellers caught it. They received the anonymous report, verified it, and blew the whistle. They made a fortune doing it. Is that justice? Is that how the system should work? Probably not. But it worked better than the official regulators did. And that brings us to the auditors. Ernst & Young audited Luckin's financials. They signed off on quarterly reports. They verified, supposedly, that the numbers were accurate. How did they miss $310 million in fake sales? How did they not notice that store traffic didn't match reported transactions? How did they approve financials where 22% of revenue was fabricated? The answer is uncomfortable. They didn't look hard enough. Auditing Chinese companies from afar is difficult. Store visits are limited. Access to local records is restricted. Auditors rely heavily on management representations. Luckin's management lied, and Ernst & Young trusted them. After the fraud was exposed, Ernst & Young faced lawsuits and regulatory investigations. Their reputation in China took a massive hit. But they're still in business, still auditing companies, still one of the big four. The regulatory gaps that enabled Luckin's fraud haven't been fully closed. Chinese companies still list in the U.S. Audit access is still limited. The risk is still there. But here's the strangest part of the Luckin story, the twist nobody saw coming. Luckin didn't die. The company was delisted from NASDAQ, the executives were fired, investors lost billions, but the actual coffee business, it kept operating. Luckin restructured in China, went private, focused exclusively on the Chinese market. And something shocking happened. It became profitable. Today, as of 2024, Luckin operates over 9,000 stores in China. More than Starbucks. The app still works. The coffee is still popular. Customers kept coming. The fraud destroyed the stock, but it didn't kill the business. Because underneath all the fake transactions and fabricated sales, there was an actual company. The stores were real. The coffee was decent. The app technology worked. The irony is almost painful. Luckin could have been a legitimate success story. The business model had potential, but they couldn't wait. They couldn't build slowly. They needed unicorn growth immediately. So they faked it, and in faking it, they destroyed any chance of becoming what they pretended to be. January 31st, 2020, 9:47 a.m. Eastern Time, the moment the stock began to fall. We've come full circle, back to that morning when $4 billion evaporated in 6 hours. Back to the moment when Luckin Coffee's fraud became public. But here's what nobody tells you about the Luckin story. Here's the uncomfortable truth that doesn't fit neatly into a narrative about corporate greed and Wall Street deception. The coffee was actually good. Customer reviews were positive. People liked the taste, the convenience, the app experience. The technology worked. The ordering system was smooth, delivery was fast, the digital integration was genuinely innovative. The stores were real. 4,500 locations existed. Employees showed up for work. Baristas made coffee. Customers bought drinks. The business model wasn't the fraud. The numbers were. Luckin could have been a slow burn success story. They could have grown steadily, improved margins gradually, and built a sustainable coffee chain in China. They had the infrastructure, the brand recognition, the customer base. But that wasn't enough. Slow growth doesn't satisfy Wall Street. Patience doesn't justify a $4 billion valuation. Incremental progress doesn't make you a unicorn. So they lied. They fabricated growth to match expectations they should never have set in the first place. And the cost, let's add it up. $12 billion in market value, gone, destroyed in the space between January and June 2020. Thousands of jobs, lost. Store employees, corporate staff, managers who had nothing to do with the fraud, all caught in the collapse. Investor trust in Chinese companies, shattered. The Luckin scandal accelerated scrutiny and delisting of dozens of Chinese firms. But the lesson? Nobody learned it. Since Luckin, other Chinese companies have been accused of fraud. GSX Techedu, an online education company, faced similar allegations of inflating numbers. Same pattern, same skepticism, same short seller reports. Wall Street still chases high-growth narratives. Investors still ignore red flags when the story is compelling enough. The incentives that created Luckin, grow fast, worry about profits later, fake it till you make it, those incentives are still there. Because we want to believe. We want to believe in the next Amazon, the next Alibaba, the next company that will 10 times our investment. We want the story to be true so badly that we ignore the evidence that it's not. David Zhang, the Seattle engineer who lost $80,000, never got his money back. He never bought that house in Bellevue. He rebuilds his kids' college funds slowly, through index funds and savings accounts, strategies that will never make him rich but also will never wipe him out. In an interview 5 years after the collapse, he said, "I learned that when everyone's excited, that's when you should be scared. When the story sounds perfect, that's when you should walk away." But most people won't walk away. Most people will hear the next incredible growth story and think, this time it's different. This time it's real. And somewhere, in some company, executives are facing the same choice Luckin faced. Miss projections and watch the stock crash, or inflate the numbers just this once, make up the shortfall next quarter, borrow growth from the future. Some of them will choose to lie, and the cycle will continue. Today, in Shanghai, Beijing, Guangzhou, there are 9,000 Luckin Coffee stores. They're busy, profitable. Lines of customers waiting for lattes and cappuccinos. The company that was supposed to be dead, that was delisted and destroyed and exposed as a fraud, it's thriving. The fraud destroyed the stock. The SEC extracted penalties. Executives were banned and fined. But the coffee survived. Luckin Coffee was supposed to be China's Starbucks killer. It was supposed to revolutionize the industry, disrupt the giant, change everything. Instead, it became a $12 billion lesson in what happens when you fake it till you make it, and forget to stop faking. The stores are still there. The coffee is still brewing. And somewhere, someone is placing an order on the Luckin app, completely unaware that the company they're buying from once perpetrated one of the fastest frauds in Wall Street history. $300 million in fake sales, every quarter, for over a year. And the people who did it, they thought they'd get away with it. They almost did. But someone inside said no. Someone compiled 89 pages of evidence. Someone pressed send. And $12 billion disappeared.